Welcome to Park Place Investment. I want to thank you for joining me today. At Park Place, we provide a platform where you could educate yourself on investing in commercial real estate. At the same time, we provide a marketplace where you could find the right syndicated commercial real estate deal to invest in. For most of us, our investments in real estate start with the purchase of our first home. I am sure you could recall the excitement you felt when you finally closed in on your house. After all the hard work that you had gone through, finding the right home, getting the right loan, getting the inspection done, the appraisal done, and finally being an owner of your new home. For some of us that own our own homes, the next step is to purchase an office where we work at. And that's always an exciting feeling that now you've invested in commercial real estate as well. However, most of us stop investing in real estate at this point. I'm sure you walked through your city's downtown area or city centers and found these large buildings there, whether it is a multifamily apartment, hotel buildings, office buildings, and thought to yourself, wow, these are owned by large corporations or multi-million-dollar investment firms. However, I'm here to tell you that through real estate syndications, you also have an opportunity to invest in these types of properties. But before getting into why you should invest in real estate and what syndications are, let's talk about why real estate is such a great investment. There's different types of investment assets that we could invest in. There are stocks, there are bonds, you could hold your money in cash, you could have precious metals stowed away as gold, and you could invest in real estate. There are certain measurements or metrics that you should always look at when you make an investment. Is my investment giving me a steady cash return? Is my investment going up in value? So when I sell it, I'm actually getting capital gains. The returns on my investment, are they protected from taxes? And can I use the bank's money as a loan to increase the amount I could invest in? And that's called leverage. Now let's compare these assets and to these metrics and see how each of them hold up. For securities such as stocks and bonds, some of these securities do give dividend or have a yield. But a lot of stocks don't have any dividends, so I put plus and minus for cash flow. Stocks and bonds typically go up in value, and that's why we invest in them. So the equity buildup is definitely there. Unless you invest in stocks and bonds through a retirement account, you do have to pay taxes on them. Typically, people don't borrow money on margin, we call it, to buy stocks. And if they do, the interest rates usually are much higher than in borrowing on real estate. And the reason is stocks are typically volatile, or they go up and down more. So your broker that you're borrowing the money from is demanding a higher interest rate for the volatility. With cash, you really don't have a cash flow. The cash doesn't go up in value. As a matter of fact, with inflation, every dollar you hold is going down in value through the years. There's no tax advantage to holding cash, and there's no leverage. Precious metals such as gold don't give you a cash flow. However, they typically do go up in value. That's why you purchase them. There's no tax advantages, and you can't usually use leverage for a gold purchase. Now let's look at real estate, and you could see that all the four criteria are met. Real estate has great cash flow. It goes up in value with time. There are tax advantages, so your returns are typically, you could protect them from taxes. And there is definitely use of leverage. Your bank is willingly giving you money with low interest rate to purchase your property. Now this is a graph that shows a 20-year span of time, and it compares in the blue real estate, and in the red the S&P 500, which is a overall measure of the stock market. And as you could see, real estate return over time has always been better than the stocks. The next important thing to look at when you're looking at investment is not only the returns, which are on this side of the graph, and also the standard deviation or the risk. That's a measurement of risk. Typically we say if there's a higher risk in an investment, the return should be higher too, because you should be rewarded for the risk you're taking. And if you look at, for example, investing in commodities or small cap stocks or small company stocks, you could see that the risks are much higher. But look at the small cap stocks, the returns are higher because the risks are higher. Very safe assets, typically like treasury bills, you could look at like government bonds. The risks are very low, but also the returns are very low. Now let's look at real estate. In the case of real estate, you have very low risk, but also the returns are great. So this is the one type of investment that, as you could see, that you could actually not only have high returns, but low risks. And this graph also shows this in a different way from 1934 to 2009. Here's real estate, here's stocks, and here are bonds. The blue graph shows the number of years within this time period where that asset class has gone up in value or appreciated. And as you could see, real estate has gone up in value 70 years out of this time period, as opposed to stocks or bonds. Now let's look at the risk or the amount of years that's depreciated. As you can see, real estate, which is in the risks are in gray, it has depreciated the least amount of years in this time span. And this is a portfolio of a large manager which has three different types of portfolio. In portfolio number one, there's no real estate. The blue is stocks, the yellow is bonds, the gray is treasury bills, and red is commercial real estate. So portfolio A doesn't have any commercial real estate in it. As you can see, the return is 8%, 8.23%, and the risk, which is standard deviation, is 9.8%. In portfolio B, they've added 10% of commercial real estate. And as you could see, the returns have gone up, and actually the standard deviation, the risk has gone down. And if you look at portfolio C, where now you have 20% of the investment in commercial real estate, the returns have gone up, and actually the risk have gone down again. So what I'm trying to get at is the fact that real estate increases your returns, at the same time decreases your risks. And this is very important when you want to invest. In this series of graphs, I want to show you that the wealthy people realize this, and 50% of the total world's wealth has been created by real estate. Interestingly enough, and we are actually lucky to live in the United States, because real estate and investing in real estate has not been accessible to the world's population. Only 13% of the world's population could invest in real estate, and most of those people live either in the US or in Western countries. Unfortunately, Americans retire seldomly rich. By the time they reach 65, only 1% of Americans have been retired in a what we call as wealthy. And my goal is to show you why real estate should play a bigger part in your investment and how you could retire wealthy with investing more and more of your portfolio in real estate. In the next talk, I'm going to talk to you about what real estate syndications are and how you could take advantage of investing through real estate syndications and generate long-lasting wealth for yourself and your family.